Netflix just reported its latest results, and the business still looks strong on the surface. In Q2 2026, revenue reached $12.6 billion, up 13.4% year over year, while net income came in at $3.4 billion, up 8.8%. And yet, despite those positive results, the stock is trading at around $69 and is down about 27% year to date. Netflix is still up around 31% over the last 5 years, but the stock is now trading far below its previous all-time highs. So the big question is Netflix's recent drop justified, or is the market being too pessimistic? And more importantly, is the stock becoming attractive at today's price, or are investors still facing limited upside after years of strong growth? In this Simon Says video, I'll break down Netflix business quality and financials, its forward outlook and growth estimates, and lastly its valuation to estimate its owner's earnings and determine a possible fair value of the stock. Before we start, here's an important disclosure. This video is produced by Simon Says Formula. I am a private investor, not a financial advisor, and this video is for general information and educational purposes only. Because this video discusses a specific stock and includes valuation estimates, it may be considered an investment recommendation under EU rules. However, it is not personal investment advice, and it is not tailored to your financial situation. At the time of this analysis and publication, I hold a long position in Netflix Inc. My position may change after publication. You can find the full disclaimer and methodology in the video description. Let's start with the business model and how Netflix makes money. Netflix is mainly a subscription streaming business. Most of its revenue comes from people paying monthly fees to watch Netflix's movies, series, documentaries, and other content. This gives Netflix a recurring revenue model because customers pay again and again every month as long as they stay subscribed. Netflix also has an advertising supported tier. On this cheaper plan, Netflix earns money in two ways: from the lower monthly subscription fee and from advertising shown to viewers. So compared with the old model where Netflix only relied on subscription payments, the ad tier gives the company another way to monetize its audience. Geographically, Netflix is still largest in the United States and Canada, followed by Europe, the Middle East, and Africa. Latin America and Asia Pacific are smaller today, but still important for long-term global growth. So overall, Netflix makes money through a simple but powerful mix of recurring subscriptions, advertising revenue, and global scale. That is why I rate the business model as positive. Now on the revenue side, Netflix's growth looks very strong. In Q2 2026, revenue reached $12.6 billion, up 13.4% year over year. On a trailing 12-month basis, revenue reached $48.4 billion, which was up 16%. Looking at the longer-term trend, Netflix revenue has compounded at about 14.6% over the last 3 years and 20.3% over the last 10 years. Total revenue growth over the past decade was more than 534%. So unlike many mature companies, Netflix is still showing strong top-line momentum, even at a much larger scale than before. The chart also shows a very consistent upward trend in trailing 12-month revenue from 2016 to 2026, with only a few periods of slower growth. That is why I would rate Netflix's revenue development as positive. Now let's look at Netflix's operating income and net income. On the operating income side, Q2 2026 came in at $4.2 billion, up 11.1% year over year. On a trailing 12-month basis, operating income reached $14.4 billion, up 16.7%, while the operating margin stood at 29.7%. That is a very strong margin profile, especially for a company that still spends heavily on content and competes in a very competitive streaming market. Net income also looked strong. In Q2, net income came in at $3.4 billion, up 8.8% year over year. On a trailing 12-month basis, net income reached $13.6 billion, up 33.2%, with a net income margin of 28.2%. However, it is important to note that Q1 2026 included a one-time $2.8 billion termination fee related to the failed Warner Bros. Discovery deal. So the trailing 12-month net income growth is partly inflated by that one-time item and may look stronger than the underlying business trend. Looking at the longer-term picture, the trend is still very impressive. Over the last 3 years, operating income compounded at about 36.7% per year, while net income compounded at about 47.6%. Over the last 10 years, operating income compounded at about 49.7% per year, while net income compounded at about 58%. So overall, I would rate Netflix's operating income and net income development as positive. The only caution is that recent net income growth includes a one-time boost, so I would focus more on the strong operating income trend and the high margin profile. Next, let's look at Netflix's cash flow. Operating cash flow in Q2 came in at $1.7 billion, down about 28% year over year. However, on a trailing 12-month basis, operating cash flow reached $12 billion, up about 32%, with an operating cash flow margin of 24.7%. Free cash flow showed a similar pattern. In the quarter, free cash flow came in at $1.5 billion, down about 32.7% year over year. But over the trailing 12 months, free cash flow reached $11.2 billion, up about 31.2%, with a free cash flow margin of 23.1%. The reason free cash flow was only slightly lower than operating cash flow is that capital expenditures are very low. CapEx was only about $0.2 billion in the quarter and $0.8 billion over the trailing 12 months. That equals just around 1.7% of sales, which shows that Netflix is not very capital intensive in the traditional sense. Now the question is, why did free cash flow decline so much in Q2? The main reason for the weaker operating cash flow was changes to working capital, especially accrued expenses and other timing-related cash movements. The second important factor is content spending. Netflix spent around $5.1 billion on cash content in Q2 and $19.6 billion over the trailing 12 months. That means Netflix is spending around 40.5% of sales on new content. This content spending also pressures operating cash flow, because Netflix has to pay cash to produce and license shows, movies, and other content. So even though normal CapEx is low, Netflix still has a very large ongoing investment burden through content. A few key takeaways stand out. First, cash flow has grown strongly from 2021 to 2026. Second, CapEx is low, so Netflix is not very capital intensive in the traditional sense, but content spending remains very high at almost 41% of total sales. This makes the cash flow profile less clean than it first appears. Third, net income is consistently higher than free cash flow, mainly because of high cash content spending and changes in working capital. And fourth, Netflix has used part of its cash generation for decent stock buybacks in recent years, with an average of around $7.9 billion in buybacks from 2023 to 2025. I initially considered giving Netflix's cash flow a positive rating because the company generates a strong free cash flow margin of around 23%. However, working capital timing and heavy cash content spending make the cash flow profile more complicated than it first appears. For that reason, I have decided to rate Netflix's cash flow development as neutral. That said, I do acknowledge that this is a very conservative rating. Now let's look at Netflix's balance sheet. At the end of Q2, Netflix had $9.1 billion in cash and short-term investments. Total debt was $14.3 billion. That leaves the company with net debt of roughly $5.2 billion. To judge whether that debt level is manageable, I compare it with operating income. Using trailing 12-month operating income of $14.4 billion, Netflix's net debt to operating income ratio is only 0.36 times. That is very low, and it suggests that Netflix has very limited financial risk. In other words, the company has more debt than cash, but the debt burden is small compared with the amount of profit the business generates. The chart also shows that Netflix has kept debt fairly stable in recent years, while cash and short-term investments have improved compared with earlier periods. So overall, I would rate Netflix's balance sheet as positive. Let's look at return on invested capital, or ROIC, which measures how efficiently Netflix turns the capital tied up in the business into profits. Invested capital tells us how much money is actually being used to run the company. In this case, I calculate invested capital as total equity plus total debt minus estimated excess cash. For Netflix in Q2, total equity was $30.2 billion, total debt was $14.3 billion, and estimated excess cash was $7.7 billion. That gives Netflix invested capital of about $36.9 billion. Then I want to calculate the return on invested capital, which measures how well the company uses the capital tied up in its business to generate profits. To do that, we calculate NOPAT, which stands for net operating profit after tax. I take operating income and multiply it by 1 minus the tax rate. Using trailing 12-month operating income of $14.4 billion and an after-tax factor of 82.8%, NOPAT comes out to about $11.9 billion. If we divide 11.9 billion by 36.9 billion, Netflix's trailing 12-month ROIC comes out to roughly 32.2%. That is a very strong result, and it shows that Netflix is generating high profits relative to the capital invested in the business. Looking at the longer-term trend, ROIC has improved significantly from the low teens in 2018 and 2019 to above 30% today. This suggests that Netflix has become much more efficient as the business has scaled. So overall, I would rate Netflix's return on invested capital as positive. Netflix's strategy going forward is really about growing engagement, scaling advertising, and strengthening its position as a global entertainment platform. First, Netflix wants to scale the advertising business. As the ad-supported tier grows, Netflix can improve monetization by earning money from both lower-priced subscriptions and advertising revenue. Management is aiming for around $3 billion in ad revenue in 2026, supported by a larger ad-tier subscriber base and more live event inventory. Second, Netflix is expanding live programming and new formats. This includes more appointment viewing, where people tune in at a specific time instead of just watching on demand. The rollout of global live streams, including events like BTS and the WWE Raw Deal show, that Netflix is moving further into real-time entertainment. And third, Netflix is trying to optimize content investment. The company continues to invest heavily in original shows, movies, and licensed programming, but the goal is to focus spending on high-quality global hits and local originals that support margins. At the same time, Netflix is still guiding for 13 to 14% organic revenue growth in 2026, while maintaining an annual content budget of around $20 billion. But of course, there are also clear risks. The first is content spending risk. Netflix must keep spending heavily to continuously deliver major cultural hits like Squid Game or Stranger Things. If there is a drought in breakout content, subscriber engagement and free cash flow could come under pressure. The second risk is subscription fatigue and price hikes. Tighter household budgets and recent price increases are testing how much consumers are willing to pay for streaming. And the third risk is intense tech rivalry. Amazon Prime Video recently overtook Netflix in US streaming share, and deep-pocketed technology companies can fund streaming losses using profits from their broader ecosystems. So overall, I would rate Netflix's strategy and risk outlook as neutral. There are clear growth opportunities in advertising, live programming, and global content, but the risks from content spending, price sensitivity, and competition make the outlook more balanced than purely positive. Now let's look at Netflix's revenue and EPS estimates. Based on the forecast shown here, analysts expect Netflix to keep growing revenue over the next several years. Revenue is estimated to reach $51.3 billion in 2026, which would represent growth of about 13.4%. After that, growth is expected to slow gradually, but still remain healthy, with revenue increasing by around 11.3% in 27, 10.2% in 28, and 8.2% in 29. So while the growth rate is expected to decelerate as Netflix becomes larger, the company is still expected to deliver solid top-line growth. On the EPS side, the forecast looks even stronger. Earnings per share are estimated to rise to $3.60 in 26, up about 42.3%. However, part of that large increase is driven by the one-time payoff from the failed Warner Bros. Discovery deal. So I would be careful not to treat the full 42.3% EPS growth as normal underlying earnings growth. Even so, the longer-term earnings outlook still looks attractive. EPS is expected to grow by about 6.1% in 27, 19.6% in 28, and 17.1% in 29. That suggests analysts expect Netflix to keep expanding profits faster than revenue, helped by operating leverage, better monetization, and stronger margins. So overall, the growth estimates look strong, especially compared with many more mature media and consumer companies. There are still execution risks, but the combination of continued revenue growth and strong expected EPS growth supports a positive rating. Next, let's translate those revenue estimates into one combined 3-year growth forecast. I start with Netflix's trailing 12-month revenue in Q2 26, which was $48.4 billion. From there, I include the remaining growth expected in the second half of 26, which is about 6%. Then I add the full year revenue growth expected in 27 at 11.3% and in 28 at 10.2%. Finally, I include the partial growth expected from Q1 to Q2 29, which is about 4.1%. When I compound those periods together, the result is an estimated 3-year revenue growth rate of about 35.3%. So Netflix is still expected to grow at a strong pace, especially compared with many larger and more mature companies. That supports the positive growth outlook from the previous slide. Now let's wrap up the business quality and forward outlook with the scorecard. Starting with the business model, I rate Netflix as positive because it is a global subscription streaming platform with recurring revenue and additional upside from advertising. Revenue also gets a positive rating. Netflix has grown revenue at a 10-year CAGR of 20.3%, which is very strong, especially for a company that is already operating at global scale. Profitability is positive as well. Operating income has compounded at 36.7% over the last 3 years, and the operating margin is now around 29.7%. Cash flow gets a neutral rating. Netflix has a strong free cash flow margin of 23.1%, but cash content spending is still very high, at around 40.5% of sales. The balance sheet is positive, with net debt at only 0.36 times operating income, which suggests very low financial risk. Capital efficiency is also positive, with a ROIC at around 32.2%. Strategy and risk gets a neutral rating. Netflix has clear growth opportunities in advertising and global entertainment, but heavy content spending and competitive pressure remain important risks. The 3-year growth estimate is positive, with an estimated compounded growth rate of 35.3% over the next 3 years. And finally, these scores feed into my required return and valuation multiple. Because Netflix is a high-quality business with strong profitability, low financial risk, and attractive expected growth, I require an owner's earnings yield of about 6%. In simple terms, that is the same as paying around 16.7 times owner's earnings on an enterprise value basis. So overall, Netflix scores very well on business quality, especially in revenue growth, profitability, balance sheet strength, and capital efficiency. The main reasons I am not using an even lower required return are the neutral cash flow rating, the ongoing need for heavy content spending, and the risks around competition and pricing power. Now we move into the valuation part of the analysis, starting with owner's earnings, a concept popularized by Warren Buffett. The goal here is to estimate how much cash the business could realistically generate for owners after the normal reinvestment needed to maintain the business. To calculate this, I start with core operating income. Then I adjust that operating income for taxes, add back depreciation and amortization, and subtract my estimate of maintenance CapEx. The important challenge with Netflix is how to define maintenance CapEx. For many companies, using normal capital expenditures would be a reasonable starting point. But for Netflix, I do not think that would be correct, because traditional CapEx is very low, while cash content spending is extremely high. Netflix's real reinvestment need is not mainly factories, equipment, or physical assets. It is content. So one could argue that cash content spending should be used as a substitute for maintenance CapEx. However, for this estimate, I use depreciation and amortization plus CapEx as my maintenance CapEx substitute. This is not perfect, but I think it is more realistic than using only traditional CapEx, while still being less harsh than treating all cash content spending as maintenance spending. Now putting in the numbers, Netflix had core operating income of $14.4 billion over the trailing 12 months. I apply an after-tax factor of 82.8%, then add back $17.7 billion of depreciation and amortization. For maintenance CapEx, I use depreciation and amortization plus CapEx, which comes out to about $18.5 billion. After putting those numbers together, my estimated owner's earnings for Netflix come out to about $11.1 billion. This is the number I will use as the foundation for the valuation, instead of relying only on reported net income, free cash flow, or standard earnings multiples. Now that we have estimated owner's earnings, we can use that to calculate a baseline fair value. This is my zero growth valuation, meaning I am asking, what would Netflix be worth today if I gave the company no credit for future growth? I start with estimated owner's earnings of $11 billion. Then I apply an enterprise value to owner's earnings multiple of 16.7, which comes from my required return of 6%. That gives me an estimated enterprise value of about $184.4 billion. From there, I subtract total debt of $14.3 billion and add back total cash of $9.1 billion. That gives me an estimated equity value of about $179.1 billion. Finally, I divide that by the number of shares outstanding, which is about 4.2 billion shares. That gives me an estimated fair share price of around $42.50 based on current owner's earnings. Now, to be clear, this is not a DCF model. It is a simple owner's earnings yield valuation based on what the business is earning today without assuming any future growth. Now let's look at the growth-adjusted valuation. In the previous slide, I estimated Netflix's fair value based only on current owner's earnings, with no credit for future growth. Now I want to ask a slightly different question. What could Netflix be worth in 3 years if it actually grows in line with my estimate? I start with owner's earnings of $11.06 billion and apply my estimated compounded 3-year growth rate of 35.3%. That gives me adjusted owner's earnings of about $15 billion. Then I apply the same enterprise value to owner's earnings multiple of 16.7, which gives me an estimated enterprise value of about $249.3 billion. From there, I subtract total debt and add back total cash. That gives me an estimated equity value of about $244 billion. Finally, I divide that by 4.2 billion shares outstanding. That gives me an estimated 3-year growth-adjusted fair price of about $58 per share. I want to emphasize again, $58 is not today's fair value. This is where my fair value estimate could move over the next 36 months if Netflix hits the growth assumptions used in this model. So by mapping out both calculations, we now have a valuation runway. Now let's bring the valuation together and compare it with the current share price. As of July 17, 2026, Netflix was trading at around $69 per share. Based on current owner's earnings, my estimated fair price is $42.50 per share. That implies roughly 38.3% downside from today's price. Even if I give Netflix credit for the estimated 3-year growth outlook, my growth-adjusted fair price comes out to $58 per share. That still implies around 15.9% downside from today's price. Then I apply a 10% margin of safety. With that margin of safety, the current earnings fair price drops to $38.30, while the 3-year growth-adjusted fair price drops to $52.20. So under this model, Netflix would still need to fall before it becomes attractive. Now let's put the valuation into perspective on the chart. At the current share price of around $69, Netflix is trading above all of my estimated fair value ranges. My current earnings estimate gives me a fair value of about $42.50 per share. And with a 10% margin of safety, that falls to about $38.30. Even if I give Netflix credit for the expected 3-year growth, the fair value only rises to around $58. And with a margin of safety, that falls to about $52.20. So under this owner's earnings model, Netflix still looks overvalued at today's price. The way I see it, Netflix is clearly a high-quality business. It has strong revenue growth, high margins, a strong balance sheet, and excellent capital efficiency. But there are also real risks that should not be ignored. Netflix still has very high cash content spending, and even though that spending supports growth and engagement, it also means the company has to keep investing heavily to maintain its position. On top of that, competition for attention is intense. Netflix is not only competing with Disney, Amazon, and other streaming platforms, but also with YouTube, TikTok, gaming, sports, and social media. And this is where valuation really matters. Netflix is a great company, but it is still mostly a streaming business. So if I am paying a high price for Netflix, I also have to ask what else I could buy instead. For example, Alphabet gives me exposure to YouTube and Amazon gives me exposure to Prime Video, but both companies also come with much larger businesses outside of streaming, like search, advertising, cloud, and e-commerce. That does not mean Netflix is a bad investment. It just means that at the current price, I would want a larger margin of safety before choosing Netflix over some of those more diversified alternatives. That matters because even great companies can become unattractive investments if the entry price is too high. For me, based on this model, Netflix may be a great business, but at the current price, I do not see enough margin of safety. So I would rather wait for a more attractive entry point or for the stock to be punished more by the market. If you enjoyed this video, make sure to hit the like button, subscribe to the channel, and leave a comment below with your thoughts on Netflix as a business. Thank you so much for watching this Simon Says video, and I'll see you in the next analysis.